Hi everybody, welcome back to our continuing discussion of Chapter 11. In this video, we'll talk about treasury stock. As always, I strongly recommend that you download and print the PDF version of the worksheet or download the Excel workbook so you can follow along and practice with the video. Treasury stock is discussed on pages 429 and 430 of your textbook. Treasury stock is created when a company buys its own stock usually on the open stock market. Treasury stock is never treated as an asset of the company. It is a contra equity account with a normal debit balance. It does not have voting rights. Treasury stock is noted as being issued, but not counted as outstanding. Therefore, treasury stock does not receive dividends. An asset, usually cash, is used to acquire the treasury stock, and the transaction reduces equity. And finally, gain or loss can absolutely not be recognized on the sale of treasury stock. You never hit the income statement. All of the treasury stock transactions stay on the balance sheet. Let's practice. Example number 1. Century Company purchased 1,500 shares of its own stock for $12,000 on April 15th. Let's calculate the cost per share that Century paid for the treasury stock, because we're going to need to use that number a lot. They purchased 1,500 shares and they paid $12,000 for those shares. So $12,000 divided by 1,500 shares means that they paid $8 per share for their treasury stock. Now let's write the journal entry required to record the purchase of the treasury stock. Debit treasury stock, $12,000. Credit cash, $12,000. Next transaction. On May 3rd, Century sold 300 shares of its treasury stock for $3,400. Calculate the amount to be credited to the treasury stock account. If treasury stock is purchased for $8 a share, then the amount we're going to credit to the treasury stock account is calculated at $8 per share. So let's do that calculation. 300 shares were sold, and we paid $8 per share, so the amount we're going to credit the treasury stock account is $2,400. So we have some of the pieces we need to write this journal entry. Let's get it partially written and then figure out what the missing piece is. We know we need to debit cash for $3,400 because that's what we received when we sold the stock. And we know we need to credit treasury stock for $2,400 because that's what we paid for the stock. But we need another $1,000 credit. And you would think that that would be a gain on the sale of treasury stock because we sold it for more than we bought it for. But as I said before, never ever can you record a gain or loss on the sale of the treasury stock. It has to stay in the equity section. Therefore, we're going to use another paid-in capital account. So the entire journal entry is a debit to cash for $3,400, a credit to paid-in capital treasury stock, $1,000, and a credit to treasury stock for $2,400. Now, the transactions are not that difficult with respect to transactions with treasury stock. But it is easy to kind of get lost in the middle of all these transactions. So I'm going to set up a couple of T accounts, one for the treasury stock account and one for the paid-in capital account, because it's going to be very important to keep track of the balances in those accounts as we proceed in this example. So stay with me for a moment. So I just paged down to the very bottom of this worksheet, and I wrote up a T account for treasury stock and another T account for paid-in capital treasury stock. And then I went ahead and posted the debits and credits that we've had so far in these accounts. This $12,000 debit to the treasury stock account came from the very first journal entry we wrote, debit treasury stock $12,000. And that was for purchasing 1,500 shares of the company's own stock. So I made a notation here that we have 1,500 shares of treasury stock with a debit balance of $12,000. This $2,400 credit to the treasury stock account came from the last transaction we recorded, credit treasury stock $2,400. And I made a little notation here that we sold 300 shares. Well, if we had 1,500 shares and we sold 300 of them, that means we have 1,200 shares left for a balance of $9,600. But I want to make sure I haven't made an error in math somewhere. So my question is, we paid $8 a share for this treasury stock. So does 1,200 shares times $8 a share equal the balance that's in the account? Let's check it out. And the answer is yes. This $9,600 balance is an expected balance with 1,200 shares at $8 a share. In the paid-in capital account, this $1,000 credit came from that last journal entry we wrote, credit paid-in capital treasury stock $1,000. So I've got my T accounts kind of following along with where we're at in this problem. Let's move on and do the next transaction. On May 23rd, Century sold 800 shares of treasury stock for $6,000. Calculate the amount to be credited to the treasury stock account. Remember, it went into the account at $8 a share. It's got to come out of the account at $8 a share. They sold 800 shares. So you do the calculation, then click on the video and check your work. 800 shares at $8 a share is $6,400. So we are going to credit the treasury stock account for $6,400. Let's get some pieces of this journal entry written and then figure out what the missing pieces are. We have to debit cash for $6,000 because that's the cash we received for the 800 shares of treasury stock. And we have to credit treasury stock for $6,400 because it goes into treasury in this example at $8 a share. It's got to come out of treasury at $8 a share. But we're out of balance. We need another $400 debit. And the rules with regard to treasury stock is never ever recognize income, expense, gain, or loss with respect to the treasury stock, even though this feels like a loss, because we sold the treasury stock for less than we paid for it. You cannot hit the income statement with a loss. It must stay in the equity account. So the rule is, use up your paid-in capital first. We have a $1,000 credit balance of paid-in capital. It's certainly large enough to allow us to debit the account for $400. So let's do that. Let's debit paid-in capital. Treasury stock. Now let's post this debit to paid-in capital and this credit to treasury stock to our T accounts. I posted this debit to paid-in capital account to our T account. It had a $1,000 credit balance minus this $400 debit, leaves a $600 credit balance in the account after this transaction. Then I posted this $6,400 credit to the treasury stock account. It had a $9,600 balance before this transaction, minus $6,400, leaves a balance of $3,200 in the account at that point. I explained this $6,400 that we actually sold 800 shares. We had 1,200 shares available. We sold 800 of them. That leaves 400 shares left. And check the math. 400 shares at $8 a share does equal the $3,200 balance in the account after posting this transaction here. So one more transaction to analyze, write a journal entry for, and post to our T accounts. On June 15th, Century sold the remaining 400 shares of treasury stock for $2,400. Yep, we have 400 shares left, and we sold them all. Calculate the amount to be credited to the treasury stock account. 400 shares times $8 a share equals $3,200. That's what we're going to credit to the treasury stock account. So we have some of the pieces of this journal entry. Let's write down what we have and then figure out what to do with the missing pieces. We know we have to debit cash for $2,400 because that's the amount of cash we received. We know we have to credit treasury stock for $3,200, but we're out of balance. We're out of balance by $800. And the rule is, eat up all of your paid-in capital first. And if there's not enough paid-in capital, then hit retained earnings. So let's do this. I could only debit paid-in capital $600 because that's the balance we have left in the account. Therefore, I needed another $200 debit, and I took it out of retained earnings. So the journal entry is debit cash $2,400, debit paid-in capital $600, that will zero out that account balance, debit retained earnings $200 to make the journal entry balance, and credit treasury stock $3,200. That will zero out this account balance. Let's post the paid-in capital debit and the treasury stock credit to our 2T accounts. We had a debit balance in treasury stock before this transaction of $3,200. We credited the account for $3,200, which brought its balance down to zero, which makes sense because we've sold all the treasury stock. There should not be a balance left in the treasury stock account or in the paid-in capital account. We had a credit balance of $600 in paid-in capital. We debited the account for $600, which brings its balance down to an expected zero balance. Well, that's all for this video. And this is the last video for the series of video lectures for Chapter 11. See you next time for Chapter 12.